Hello. In my today's class, I'll be discussing about the various objectives of accounting. In the previous class, we had discussed what is the definition of accounting, and we had understood the broad concept of accounting as a tool technique of recording the financial transaction. Right? In today's class, we will be concentrating ourselves in understanding the various core objectives or the scope of accounting. What exactly are we going to derive out of recording transactions, summarizing the transactions, classifying the transactions, and then presenting those transactions. So the first objective of accounting is providing information to the users for rational decision making. In my earlier class, we had discussed that there can be a lot of stakeholders who have interest in the functioning of the business. The shareholders might be interested to know the dividends that they're going to get. The outsiders would be interested to know how the business is performing, so as to understand as to when they will be repaid their principal and as well as the interest amount. The government is interested to know how much tax the government can collect from the business entity. Similarly, the consumers or the customers are interested to know what sort of future products or projects can be coming up from this business entity. So, when we are presenting financial statements, be it profit and loss account, be it trading account, or be it your balance sheet, all of the information which is there is useful to various stakeholders. So that's the first objective of accounting. The second objective is systematic recording of transactions. So what do I mean by systematic recording of transactions? Each and every transaction, be it for even one single rupee, since it belongs to the business, needs to be accounted for. You need to know from the source from which this 1 rupee has come to you. For that matter, if that's an expense that you're making, it should be clear for what reason this expenses has to be made. Because every single transaction, be it a small, a big transaction, needs to find its place in the financial statements. The third objective is ascertainment of results of the transactions. Obviously, if the business is acquiring, say supposingly new fixed assets, if the business is expending in advertisement or marketing, so all these ultimately should result into its net worth being enhanced. All this should actually result in increased revenue. All of this should actually convert into the profits, the top line and the bottom line. So ultimately, through recording these transactions, we get to know whatever expenses or whatever revenues are coming to us, whether actually it enhances the net worth of the business or not. And that is the end result of this accounting purpose. The next objective is ascertainment of the financial position of the business. So what do I mean by the financial position of the business? Financial position means that how much assets and the liabilities are associated with the business entity. So if supposingly the business has been there in place for around 2 to 3 years now, so every year there would be certain additions to the asset, there would be certain additions to the liabilities, and with each year's operation, the net position in terms of the total assets and the total liabilities and each head in the asset and each head in the liability might change. So with the help of accounting, we are well in place and well aware of what has resulted into the enhanced assets and what has resulted into the enhanced liabilities. So one of the major objective again for accounting is that we need to ascertain and find out the actual position of the business in terms of its asset, liability, and just not this, it can be market share, it can be the price of the shares. All of this we are only going to ascertain once we have exactly the financial statements in front of us. Next, the last objective that I am going to discuss in this particular class is that accounting also helps us to know our solvency position. So solvency means there are two things, one is liquidity and another is solvency. Liquidity means that as on this date, do we have enough cash and cash convertibles, so that we have cash and cash convertibles so that we are able to meet out this standing obligations. However, the solvency is a long-term phenomenon. Will the organization be able to meet out its obligations in long term? Will it have sufficient profits? Will it have sufficient cash inflows, the revenue inflows through which the solvency position can be maintained? But this we can only be able to know lest we have all the financial statements which are correctly recording all the transactions, and then is when we are going to be aware of what actual cash and asset balances that we have, so that we can be having a solvent position to pay off our standing obligations and the obligations which are going to come in future. Thank you.